So this video is sponsored by Skillshare. More about them later. So just to get a few things out of the way, yes, Ray Dalio's view will be biased. My views will be biased. Heck, even my grandmother is biased. To me, of course. So Ray Dalio is one of those hedge fund managers that is openly bullish about China's development, and his portfolio corroborates with his own worldview. So before we talk about the fund that he manages, in case you missed out my community post, I directed you guys to his latest YouTube video regarding the alleged changing world order. So if you have 40 minutes to spare, listen to it while commuting to work or something. You know what else to do while listening to me talk? Smashing the like button, of course. So what are you waiting for? Help me turn the like button blue or white. So I personally don't totally agree with everything that he proposes in that video, but it's good to listen to this varying perspective. Yes, it's going to be biased towards China, but upon closer inspection, a majority of his portfolio exposure still resides with strong American brands. So he's not a Chinese spy, but he has always been a huge advocate of diversifying across asset classes and also geography, and he walks the walk. Anyhow, let's listen to one of his responses in the latest interview about how an investor should invest and his outlook of the market in the short to medium term.
Diversify, but let me ask you, an average person who isn't, a billionaire, should they expect to get a rate of return overall on their money of 5% a year? Is that a good target? 6%, 8%? What do you think is a reasonable target for somebody who doesn't want to take undue risks?
Well, nowadays the structure of the markets and where everything is priced, and done the normal way, will give you probably a return in the vicinity of, with a lot of risk around it, of maybe in the vicinity of 4%, okay. 3%, 4%. Okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it, because there are so many financial assets. But one thing you can, they'll send you more money.
As we talk today, the stock market in the last couple of weeks has been correcting, if that's the right verb, and a lot of the air is out of the so-called bubble. Should people be selling everything and getting out of the market now because the markets are going down, or is this the time to buy?
First of all, I'm not here to give a lot of advice, but I'll give you the following thoughts.
We won't tell anybody. Just give us a
okay, just on our own. What's happened is they produced a lot of debt and gave out a lot of money, and so everybody's got money, and it's also very easy to borrow money to buy things. And as a result, if you create much more buying power, then you create goods and services. You've got much more inflation. And the Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. So now that free money is still going to be cheap money, but it's going to be a bit higher. So interest rates, let's say bond yields, have gone up about 1%. Now you take that and you adjust, everything is the present value of future cash flows, but it means that interest rate goes up 1%. That means all the other assets have to adjust. We're in a process of making that kind of adjustment. That means the days that we've had before, the easy days where they dump money on you and you don't have much inflation and you don't have much tightness, those are past. And now we're in a different kind of part of the cycle.
Now, talking and expressing your opinion is just one part of the equation. I think people are much more concerned with what you do rather than what you say, especially when Ray Dalio manages one of the biggest fund out there. So enough with appealing to authority, and in case you haven't noticed, everyone have their own specific agenda, and even the way I structured the video up until the words I use to paint a certain narrative. So please exercise utmost discretion when consuming content online. Anyway, lo and behold, the largest stock buys since Q4 of 2021 is none other than, drum rolls please, yes, it's Alibaba. He increased the position size by 30%, where it currently sits at around $500 million in value. Rather than just tagging him as a blind China bull, you can see that the following 4 biggest purchases Dalio did were all revolving around strong American brands like Procter & Gamble, Pepsi Cola, Johnson & Johnson, and of course, your good old McDonald's. So in the interview specifically, Ray Dalio did voice concerns over the upcoming performance of the index to be in the low single digits, and more importantly, there'll be a huge amount of volatility chasing those low returns. Unless you're a trader, it's probably not going to be beneficial to your heart in the near term if you see or hear someone as renowned as Ray Dalio saying something like that. So if we were to look at the fund in totality, Dalio clearly does what he preaches. He has cut his exposure significantly in broad-based emerging market ETF and also slightly in SPY, which models after the S&P 500. That being said, SPY still represents his biggest position, sitting slightly above 5%. So the more interesting phenomenon is the huge reduction in VWO, which is the Vanguard Emerging Market ETF. He reduced it by 28%. IEMG, iShares Core MSCI Emerging Markets ETF, he reduced it by 39%, and EEM, which is iShares MSCI Emerging Index, he reduced it by 55%. And as you can see, the common theme here is they are all in emerging markets. So it seems like this is a tactical movement of a fund allocation where there is this short flight to safety back to stronger, quote-unquote stronger asset classes, especially to its US counterparts. So Dalio also trimmed his gold position slightly by 4%. So no, I don't think he fundamentally believes about some of those theories out there of how the USD is going to experience hyperinflation or be debased on a significant value. So we will talk about his Alibaba position later on. But based on his latest quarterly addition, he is adding companies like Procter & Gamble, Pepsi, Coca-Cola, Costco, McDonald's. And what do all these companies have in common? Yes, not only are they operating in the consumer staples industry, they are all extremely strong brands. And what do strong brands benefit from? Brand premium and pricing power. So in short, if I may speculate here, it seems like Dalio is betting that inflation might not be as transitory as the Fed might expect, and it might not subside as quick as we want it to. These said companies are best able to hedge against this trend, at least in the short to medium term, by raising prices accordingly. So as I mentioned at the start of this video, everyone is biased to a certain extent, and this is the information age. I would argue that the most important skill set in this century is to think critically. So in order to prevent yourself from falling victim to such manipulation, you ought to continue learning and train your greatest asset, which is this 3-pound jelly here. So introducing today's sponsor, Skillshare. So Skillshare is an online learning community with thousands of online classes for all sorts of topics. They have a wide range of topics from personal finance, productivity, and even how to start your very own YouTube channel. So like investing, I think the biggest asset in your life is not your stock portfolio or even your property. It's yourself. Like everyone else, when we are at home, we always have that inertia and procrastination kicks in. So right now, I'm taking a class from Thomas Frank with regards to productivity and how to build habits that actually last. So as Skillshare is sponsoring this video, the first 1,000 people to use the link below in the description will get a month of free trial of Skillshare Premium membership. So in this 1 month, you can explore a whole host of different classes, from photography to writing and even entrepreneurship classes. So I think you will enjoy the platform as much as I did. So be the first 1,000 people to use the link below. Thank you Skillshare for sponsoring this video. Now, back to what everyone is waiting for. Why is Ray Dalio still so bullish on Alibaba? Arguably though, I can agree that Alibaba do command a certain premium on its brand, but it seems like the broader market sentiments disagree. So from how it transpired, Ray Dalio essentially tripled his Alibaba exposure in the last 2 quarters compared to Q2 of 2021. So the funny thing is, rather than looking at it on an isolated basis, he actually increased his JD.com exposure by 33% in the last quarter as well, and Pinduoduo by 38%. So although JD and Pinduoduo only makes up 2% of his entire portfolio, while Alibaba is at a staggering 3%, it seems like the Chinese e-commerce industry alone is sitting at 5%, which is equivalent to solely his SPY position. But of course, he has IVV as well, which is another variation of the S&P 500. So I think it is quite evident that Dalio remains a huge bull in the Chinese growth story and still holds the opinion that, hey, all this different Chinese e-commerce company is able to generate alpha or even act as some sort of diversification. So Evergrande, energy crisis, GDP slowdown doesn't seem to affect his assessment. What about you? So leave in the comment section down below what you think, and I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!